Investing insights with Right Property Group, exploring trends in real estate and helping property investors gain financial security.
Good everyone, how you going? Phil Tarrant here. I'm co-host of Investing Insights with the Right Property Group, and here we are. It's 2021. It's madness across property markets right across this great nation, and we've been sort of exploring those for the last 5 years or so on this podcast, and I've really enjoyed it. It's been a real privilege to be able to navigate and steer decision making for many investors right across Australia by tuning into this small piece of education, which I like to think is lacking any real bias other than hoping that you can do what you do better, and that is wealth creation journeys. I'm on that wealth creation journey. I'm trying to make a few bucks through property so I can have a better retirement, whatever that retirement looks like for me, who knows, but it's going to give me a lot of choice into the future. So thanks for tuning in. We really enjoy it, and we get a real kick out of navigating these conversations and helping to keep you informed. And this is the start of, and it's a bit of a milestone, season 5, episode 1. So season 5 being 5 years. Now we've been recording Investing Insights with the Right Property Group, and my job here is to host and curate the narrative, trying to extract information from two people who I think are leaders and have been for many, many years across real estate, and in many ways a driving force behind the emergence of buyers agents in Australia. Steve Waters and Victor Kumar from the Right Property Group. It's a good team. We have our ups and downs, more downs than ups. A lot of...
I was waiting for it. You know, over the Christmas break, I thought season 5. I wonder if Phil will sort of temper down a little bit with his with his sledging.
And I was thinking, as he was doing this intro, I was thinking, hang on, he's got a New Year's resolution, right? There's no sledging happening. Yeah. And here he comes out.
Well, I wasn't going to sledge. I was actually going to pay a compliment. But if you want to go that way, that's fine. But if you're new to this podcast, welcome. And I'm sorry about Steve Waters. You can send all complaints to questions@rightpropertygroup.com.au. We'll get to them eventually. There seems to be quite a few of them. But the voice of reason and sensibility on this podcast is Victor Kumar, who I've known for many years. And as a backstory, one of my first memories of Vic is, it's got to be 2011. And I sort of give this context in that it's a very sort of similar market right now. 2010, 2011, I think. Meeting him out the front of Rashi's on the high street of Campbelltown, looking at properties out that way. And I didn't really know him very well then, sort of spoken to him on the phone. I remember, who is this bloke? And who would have thought 10 years on that we're sort of 5 years into doing a podcast together? Mm-hmm. It's pretty cool stuff.
Who would have thought 10 years on that you walked out of Rashi's without the dinner plates?
Rashi's still there.
He's still there.
Do you know what we should just invoice them now for that plug?
Yeah.
It's
Rashi's Campbelltown on, what's the name of the street? Queen Street. Mm. It's where all good property investors start their day when they're looking for property in Campbelltown. How is Campbelltown at the moment? You still own half of it?
I wouldn't say half of it, but it is absolutely booming. Like everywhere else, It is booming, and a lot of changes happening in terms of the gentrification of the area, and, you know, various council areas pulling into the catchment area of the new Badgerys Creek Airport. Yeah. So 10 years on, that's just been a phenomenal amount of change in most areas.
And I'm not really one of these sort of reflecting types of people. I don't really know how you guys are wired. I'm always sort of thinking what's next rather than what's happened, but experience is a great leveler and a great enabler for shaping change in decision making. And I sort of just think about Rashi's just off the cuff there, but 10 years is a long time. And I think back to as a young investor, as in terms of my maturity and sophistication with investing 10 years ago, I was pretty new to it. And I remember sort of just exploring, understanding what's going on, what's all this investing stuff. Like we had Smart Property Investment then, it was a pretty new brand. Mm-hmm. And we said, hey, we should invest in property. So as people who are curating content and informing people around it, let's do it ourselves, which is the backstory to Smart Property Investment and why we teamed up with you guys as our buyers agents. But we bought really well back then.
Absolutely, we did.
Really well back then. And now with 10 years of scar tissue and experience as a property investor, and I look at this market and like you guys right across it, we're probably pretty connected with what's going on. And I sit there right now and I don't really care that much. I don't feel like I'm missing out on anything because I've got pretty good exposure to property in Australia, in Sydney in particular, Melbourne and Brizzy. So I'm not rushing out to buy stuff right now because I already got a lot.
Yeah, you've got the foundational
I've got the foundational property. So I'm not distressed. I'm not concerned at the moment that I'm missing out on potential wealth creation activity because I'm not actively buying in this market like every other Tom, Dick and Harry, right? And it got me thinking about this, about the art of patience. You know, property is an interesting asset class because, you know, to what Steve has said many times, it's not a passive investment. You've got to be involved. And I've had a pretty crap run the last sort of 4 or 5 years in property in that. A lot of repairs and maintenance, places untenanted, fixing things up, poor administration, issues with banks, yada, 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 right? It's not easy by any means, and it's not passive. However, strategic patience, as in making good decisions and then waiting and let property do what it's doing, has put me in an excellent position right now to capitalize on what would be boom markets, a bull run in property for the next 3 years.
Absolutely.
You mentioned strategic patience because I think that's a really important point. Moreover, though, a lot of what you just experienced, say, over the last 5 to 10 years, every investor with a portfolio of your magnitude experiences the same thing. And it goes through seasons, whether it's repairs and maintenance, whether it's economic effects, which is out of your hands, and that's something that we've spoke about before around control what you can. It's just, that's all part of the patience scenario because nothing is ever linear, up or down. There'll be swings and roundabouts. And now you'll start to notice that a lot of people are saying, well, this is the best gig ever.
Yep.
Property's the best gig ever because look at all this compound growth from the asset value that we control. But they very quickly forget about the hard yards that they've done for the prior years beforehand to get to this position.
That's true. And if you reflect back to the 10 years, right? So when we started in the portfolio, the metrics were relatively the same in the sense that there were a lot of people jumping into the property game. There was a bit of a frenzy in the market off the GFC and people are getting their confidence back in again. And it reminds you of what's happening right now as well. The only difference is at that time, the rates were a little bit higher, but correspondingly, the yields were higher in Sydney and across the eastern seaboard, right? So when you look at it now, it's the reverse. The yields aren't as high because we've had a huge run in price over the 10 years, but the interest rates are low. So with the differential between money coming in and money going out is relatively the same in that sense. And when you look at the portfolio from where we started, and if I look at, you brought up the Campbelltown example, we are buying circa 200, 300,000, these houses, we're not talking units, right? And the same properties right now are selling for between 700 to 800,000 easy. And that's a hallmark of...
I wish this was being filmed because you you should have seen Phil's eyes just
flutter,
light up like the size of Rashi dinner plates.
Yeah.
I feel wealthier.
So if you look at it from a viewpoint of, okay, yes, there was some admin work that need to happen. There's some decision making. There's some heartache as well when you don't have tenants or the bank doesn't restructure the loan in time and all that sort of stuff. But that's part and parcel of investing. But you've been in it long enough now to see the fruits of a labor. Most people want to have instant gratification in property, and that's where they get burned because then they go out and buy the wrong types of property.
Well, look, in today's market, there is a very real possibility that you will achieve instant gratification.
Yep. We've seen that with our clients.
Absolutely.
That we've done,
And we've had some tremendous growth almost instantly over the last 12 months, 6 months.
But we'll have a chat about that because a lot of that is just catching up the growth that should have happened that hasn't happened. And so it gets a little bit... I think it's an important point. But for our listeners, just this concept of strategic patience, and it says it, there's two really important words there. There's strategy and there's patience. Patience largely in property means time. It means time. If you want to be a bazillionaire overnight, don't listen to this podcast. If you want to be a bazillionaire overnight through property, I'm sure there's some spruikers somewhere that will tell you how to do it. And you know what? You might do it, but most of you are going to probably blow your dough,
There's
right?
someone else. There's someone out there that'll help you.
There's someone else. That's look. I'm a journalist. My job is that. You guys do this for a living, but there is people out there. If you want to be a bazillionaire overnight, good luck. Go for it. Tell me about it. I'd like to hear about it. But strategy and patience. Strategy when it comes to property investing, we've been speaking about it on this for 5 years now. This is investing inside the right property group, and it's I've got to pinch myself. We've been doing this for 5 years, right? That's a long time. It's a long time for us to be navigating this, and let's look at those 5 years. We've gone through a pretty slow market. We've been through changes to lending and how investors have been shaped by APRA requirements. We've gone through a number of prime ministers. Yeah. We've probably done 3 prime ministers, maybe 2 now, because we've had some stability.
Actually, that's been more volatile than the property market.
It's been more volatile than the property market. We've had
change of leadership.
Change of leadership. We've had, these election issues around scrapping of negative gearing. So we've diarised over those 5 years, these changes and evolutions. Now we're moving into the roaring 20s. This is what they're calling it, right? And what's happened for COVID-19, go back and listen to it. I think we've done, and we've been pretty fair during COVID-19 of how we've helped shape the narrative around property investment. And I like to think that we were saying, stay the course, it's okay. Strategic patience, take it easy. Steve, to your point, you make it all the time. Property investment is a game of finance and a game of cash flow. So these are the things that support patience. So back to my point, I'm not rushing in to get into this market. However, if opportunities, I've spoken to Steve about this, if opportunities arise, I'll be pragmatic about it. So this chat is really just, just to reaffirm to all of our listeners, don't panic. Don't panic.
I think
good or bad.
Yeah, just around the strategic patience and getting started, because they're two totally different components. And Vic mentioned earlier on that this market in its beginnings had similar vibe to what 2010-ish when you first started, Phil.
Yeah.
I'd probably differ a little bit than that, because when you first started, the fizz wasn't in the market. It came very quickly.
Not as much.
Yeah, it came very quickly afterwards. But
we got in the right time.
But the right time
Before
was,
the fizz.
But the right time was yesterday.
Yeah,
And
exactly.
it was the day before. And it was the day before.
Yeah.
And this is the point that I'm trying to make. There is nothing wrong with getting started now, because you'll see the fruits of your labour in 10, 15, 20 years' time. And one thing I can guarantee you is that people in 10 or 15 years' time, if they've done it correctly, are saying, I wish I had bought more in 2021.
That's always been the case.
Just like Phil says, I wish I had bought more in 2010, even though you went pretty hard. And I say, I wish I had bought more in 2000. It's just, that is a continuation of the same. It'll always be that way.
And I'm happy. And I guess the point I'm making, Steve, to connect in with that is that what we did 10 years ago, you can emulate that today.
Correct.
Is exactly what you're saying. So the reason why we've shared our portfolio growth is like 10 years on, design your decade. 10 years on, look what happens. We've got exposures to these markets, and we're going to get the upside growth of the next property cycle. So if you're starting out in property, if you build that foundational portfolio right at this point in time, think about what 10 years is going to be, and that is the patience, there's strategic patience around it. You too can also be, a successful property investor. And we were chatting before we come on air, Victor, that the SPI portfolios, me and Steve is going to do a smart property investment show around this at a point in time, looking at the portfolio itself, but call it somewhere $7.5-ish million in value. Now, you get a 10% uplift.
That's quite a lot of money.
In a year,
Yeah.
that's $750,000.
Yeah.
How much is that a week?
It's about $14,000 a week.
$14,000 a week just in capital.
Yeah. So
growth.
just put it in perspective, $2,000 a day.
$2,000
For just sitting around and taking action 10 years ago, now you're reaping the fruits of your labor. Yes, there'd been ups and downs in holding the portfolio, but it was within your affordability range in the sense that it took time, right? It took time in terms of admin, and it took time in the market in terms of we had the right foundational properties that went through its cycle. There were periods of heavy growth, there are periods of low growth, there are periods of good rents, and there are periods of okay rents. So that's part and parcel of owning a property portfolio. Most people, when they're owning a property portfolio or even a property, they expect it to be a rosy run. That's not the case, because there's so many different things that you can't control. You can't control your tenant paying all the time because they're reliant on a job to pay you, right? So if there's an upheaval there, it may be that they're 1, 2, 3 weeks behind in rent and they catch up. You can't control to a degree, the maintenance of a property unless you've got a good maintenance plan, a good property manager that flags things ahead of time. And then yet again, you'd have a runoff. As an example, in my portfolio, I had a run of probably about 7-8 years of no properties requiring any major renovations, right? But then from last year onwards, I've been smashed with repair requests and all that. But part and parcel of, I guess, people working from home as well. And then a whole heap of runoff hot water systems.
I had the same.
I've got that right now. I've had to
year.
do 3 recently.
Extremities of weather. Let's put it down.
That's right.
Put it down to that. But the one thing that you can't control in any of this, and it does have an immediate and direct effect to value, is government policy.
Yes.
Right.
Yes.
So it's really,
That's
really
the sovereign risk.
Well, it is. And as we've talked about before, control what you can, and don't worry about what you can't, as long as you're well mitigated in and around your cash flow position, and hopefully the correct areas, so that they will ride those periods of time that are in flux.
Yeah. So what do you mean by, in terms of not being able to control, say, government legislation? A good example would be negative gearing. If you've built up your portfolio and the ability to hold on to your portfolio purely off your tax rebates, and that's the only way you can hold on to your property without compromising lifestyle, you've got 2 major issues that are always there ready to happen. One is you've got to pay tax to be able to claim that to begin with. In other words, you need to have a job. Right. And the second is legislative change. Like a couple of years ago in the last election, that was the platform, tinkering with negative gearing.
It's about to happen again.
Yeah, that's right. Yeah. So, and on that, in terms of about to happen, because we've spent so much money on shoring the economy up with COVID, there is likely to be some structural changes in terms of how the government claws back the money. because we need to get back into black into the
And everyone's just hitting rewind
Yeah.
now on the podcast. Do I just hear that correctly? I mean, that's a bit of a guestimate.
Yeah.
We don't really know, but we would expect there to be some change. I think it'll be a very game government to...
So you start messing around with negative gear, particularly with everyone, 1 in 8 Australians claim some sort of deduction as a property investor, right, on their tax return. Yeah, which is quite a lot.
So that was a moment in time which was a crisis, as was COVID, as was APRA, as was an election. There's always a crisis.
There's always a crisis.
Yeah. It's just how big is it and how does it affect you immediately?
Yeah.
Well, things like the government has spent a fair bit of money. We've spent more money fighting COVID than a world war. We've spent more than pretty much any other nation in terms of government stimulus in fighting COVID, right? It's a big
pot of money.
chunk of money.
But for anyone that sits back and thinks, well, the reason that the market is going well is because of all this stimulus and what have you, they don't know enough about the market to realistically give any solid commentary around it. What we have today has been helped a little bit by COVID, and that's more around the cost of money. But we were already, years prior to this, we were already heading into an undersupplied market, and we were very public about that a couple of years ago. Just as we've mentioned many times, COVID has amplified the situation. It's not the cause of what we have today in terms of the market. It's just...
Because the underlying problem was already there.
Correct.
Yeah.
Yep.
So if, for Investing Insights, Right Property Group, if 2019 was identified with APRA intervention into lending, which stifled investment activity, if 2020 was identified by COVID-19 and the impact of COVID-19 and our discussion around it, what's 2021 going to be known for Investing Insights, Right Property Group?
I think it's going to be some of the most talked about growth period of time ever. In fact, I was speaking to someone the other day, and for me, this has a very similar vibe to the year 2001, 2, 3.
Yeah.
Where the market was just...
Bonkers.
Yeah, it was. Now,
if that's a property term, bonkers.
It
That's
is now.
it. Yeah. Market is bonkers.
The sophistication levels, isn't it?
You guys use
comes
words.
back to the host, It brings up the sophistication level.
Proper English like. But it has the same vibe as what we're experiencing today. And that market ran for a little bit for all. Maybe there was some different components of the reason, such as the low doc loan, but there was still an undersupply.
Yep.
Overlay that with technology and the saturation of information or availability of information. And today we're in a very similar yet unique position, being that if you look at the peaks and troughs of the markets, if you go back in yesteryear, way back, and those peaks in the market would last a little longer, there'd be a slow, steady time down to the bottom of the market, and then it'd be back up to the market. But there were big periods of time between peak to peak.
Yep.
Or even
It's like a real sine sort of curve, right?
Correct. Yeah.
That's right.
Yeah.
Whereas today, those peaks are way closer together.
And they're more triangular. They're
Correct.
not curved in that sense.
Yeah, and it's almost, no matter what the asset class is, it does the same. And there's a few reasons for that, I believe, and we've spoke about it before, is people's education piece today is far stronger than what it was yesteryear, just because of that availability of information to make educated decisions around property. There's so much of it out there.
Oh, it's completely transformed. And therein lies the challenge, right? If you think about these cycles, so early 2000s, the way people got property invested, we've spoken about this for some time, the way that people got information during that market 2 cycles ago, let's call it 2 cycles ago, was property investment seminars, right? It's where most people all exposed, right? That's where people
That's
got
how
their
they
info.
got into property.
That's how they got that, yeah. The cycle subsequent to that, when we started investing, largely most people got their information from that sort of stuff, but then also like magazines. You go to the newsagent, buy a magazine. That's where most people got their information.
And you got the growth factor from the back of the magazine where it had all the tables and
Absolutely.
all that, right?
Or a good news story.
Or a good news
Jack's
story.
bought in Humpty Doo.
Yeah.
Got to buy Humpty Doo.
That's it, got to buy Humpty. And now in this, most people are getting their information through this sort of medium, right? Podcasts, right? We've spoken about the democratization of information in property. So now there's too much information to help steer decisions. Hence the reason why we like to do Investing Insights with the Right Property Group, and we get pretty good feedback on this. So what we're doing must be pretty well. We'll appreciate more feedback, how we can help shape and steer it, questions@rightpropertygroup.com.au. But we're 5 years in. Well, this is the 5th year, start of the 5th year. What would you like more from us as a team, Victor? What do you reckon we can do in this podcast as we shape 2021, which is going to be the year of, Steve, to your point, of talking about the boom, right? Inverted commas, the boom.
Yep.
I don't like the word boom.
No.
Yeah. Okay. Well, we can shape the lexicon. What do you want to call it?
I'll call the
Let's give us something. No. Well, let's talk about, allegedly, you crafted C change with a C.
Not allegedly, I did. C change,
as in the COVID change. I'm going to claim FOMOP. Fear of missing out on property, FOMOP. You had something before. What
Fongo.
Was it? Fongo, which was?
The fear of not getting out. So that was back in
19.
I think it was 18 or thereabouts. Yeah.
I'd like to point out, Becky, you've contributed nothing except for maybe pigeon pairing, which I use all the time.
I don't go into these fancy acronyms, right? So
give us something.
Give us something. Come on, you're on the spot.
What do you hope to achieve? What do you hope we can achieve this year?
Yeah, and that's a fair question. I want to go back to your bit about information, right? That there's too much information. So if you go back to the yesteryears of when we started, so 20 years ago, the problem was reverse. Right? You had not enough information. So you said, where can I get some information to get started? Right? When you fast forward it to 20 years now, the problem is reversed where I've got too information, I don't know what to do. Right? So what we would like to do as part of the podcast this year is to drill down the information to absolute, get rid of the hype, and this is what you need to do. And these are the types of properties that you need to buy as a foundational. These are types of properties, if you've already got the foundational, this is what you would want to buy in terms of adding to your portfolio. And also perhaps getting people to really look at, don't jump in feet first. There's some things that you need to do beforehand, such as restructuring your mortgages well beforehand, making sure you've got the finance hot and ready in your hand before you even go to property, and then looking at it from your own individual circumstances. Rates at 2.5%, circa 2.5% right now with most banks. You want to be doing
Not any of mine. What about yours?
Yours is 4.99. I know that.
I have some of that. Yeah.
So you want to be doing your figures on, say, a 4.5% interest rate, so that we can factor in the interest rate rises down the track, so that we don't get caught out when that happens. And we've done the initial heavy lifting, and we have to then offload the properties when it's actually coming to fruition, like your portfolio is coming to fruition now. We're talking about, $2,000 a day that you're making in equity as a figure. That's where we need to be in terms of market this year.
But let's just back the truck up a little bit to something that you said around creating levels of knowledge that everybody could utilize. And let's use the word strategies, which I'll sort of explain a little bit further on. But we also need to be very fair and let everybody know as forcefully as we can that everybody is quite unique.
Yes.
So it's not about...
not a one-size-fits-all.
Correct. So it's not this type of property in this area suits and fits everybody's long-term objectives or personal circumstances at this moment in time, which is why we keep talking about this designer decade.
Yes.
The 1, 3, 5 and 10-year marks. And we need to be true to that. But the strategy... and it's a bit of a bugbear of mine. Like there's a lot of rhetoric on social media and what have you around strategy. Book a free call for a strategy and whatever it may be. I have a problem with that because for me, there is no chance to create a strategy until we know what the finance capacities are, what the product is, what the rate is,
and that's
personal
that's not a
circumstances.
15-minute conversation, is it?
No, that's a big piece as opposed to we'll book your free strategy call because you know nothing about me. How are you going to create a strategy? Oh, I see, because it's a one-size-fits-all strategy.
Yeah. So it's like, you go to a doctor and him, without doing any tests, any blood tests and all that, they say, you know what, I think you've got heart problems and all that, here's some tablets. That's what most strategy sessions become, is that they presuppose the underlying issues and they give you a solution for that. You need to do some tests, in other words, get finance, see what your borrowing capacity, what your household budget is, and how much can you really afford, and what's going to happen in life in the next couple of years to then set up the portfolio and the strategies accordingly.
Yeah, and I'm quite happy to sit down with people once they know what their finance capacities are to create strategies.
Yeah.
But if you need help with that because you don't know enough around that piece of the pie or that piece of the puzzle, then there still needs to be a conversation.
People bandy this word around strategy really easily, and strategy, being strategic, is a pretty sophisticated approach to stuff. You don't buy a property investment strategy off the shelf. It's like a fingerprint's DNA. Everyone's unique. Now, there is some things that apply to all, or some principles that you can apply to forming a strategy.
Correct.
That's cool. But you've got to be strategic and make sure you do that well. And to your point, Victor, around these three different sort of moments in time where not a lot of information, or information was scarce, 2000s.
So people didn't know what to do.
2010, there was information out there. It was in a particular way. And now there's bloody information everywhere, right? If I think of a buyer's agent, so the value or role of a buyer's agent, back when there wasn't a lot of information around, you're paying for that advice and that insight, right? Now, where there's heaps of information around, you're paying for the advice and insights around how to use it, how to actually navigate that. So it's just as relevant today. And I think, I was chatting to someone the other day, a buyer's agent, I went, property's going to go up in value everywhere. So why do you need a buyer's agent in this market? You just buy anything and you're going to fluke it, right? And it had a really good discussion with around. I'm quite keen on your views on it. My position on it was, now is when you need a buyer's agent more than ever before, because if you buy the wrong property now, you might get a little bit of a spike, but then you're going to have long-term tail of it.
And I might be a little bit biased in what I'm about to say, but I think it's because I have done the hard yards. I have made the mistakes when there was no one like us, and so it was suck it and see. I agree with the point that probably now's the most important time to have a buyer's agent, because as we chatted a little earlier on around, you could almost buy an outhouse in any major area in Australia and it'll do well over the next 12 months. And that's really, really cool. But that's not what you gauge the property's worth on. It's how will it perform in a normalised market or even in a softer market, because that's when the rubber hits the road. That's when the head games or the mind games start to accumulate. Should I sell? Is this the right asset? In terms of the buyer's agent sort of analogy though, there's a very big difference between a buyer's agent and an investment strategist. And hopefully they have within their own ecosystem, and this is not plugging us, there's a lot of good buyer's agent out there. This is just how I see it. The difference between a buyer's agent and a strategist is a buyer's agent takes a scope, and it's you go to them and you say, I'd like a 4-bedroom house with a purple roof on the moon. And the buyer's agent go gets. That's what their job is. An investment strategist is to actually create the strategy once they know what all the pieces of the puzzle are and implement. But the strategist's job is also there at the back end of the purchase. So just like your portfolio, Phil, we sit down, I do the reviews with you because that's where the money's left on the table. That's where the important moves need to be made for longevity within the portfolio.
And therein there's strategic patience.
Correct.
Which is completely linked to front-end strategy, saying, buy this is what's going to happen initially, and then we've got to think about the long term. What's the long term going to look like? And that's what we're strategizing for. That's the time. Now, Victor, considering this strategic patience, a bit of example with us and how 10 years on, we're in a really good position, making a couple of grand a day in terms of paper capital growth money. It's not real money. It's only there if I realise it.
It's a wealth position.
And there's going to be cost associated if you ever want to realise that. So just putting that aside. But there's essentially two different people in this market right now. There are those who are like us, who already have significant exposure to property and should be reasonable good times ahead of us. Then there's those that want to be us in 10 or 20 years' time. You guys are pretty much one cycle ahead of where I am. You guys sort of got going in early 2000s. We got going sort of in 10, right? So you've had essentially two cycles. You've got to see two cycles of growth. We got one, right? So there's those people that want to emulate us into the future. So let's chat about people like us in this market right now. We've still got about 10 minutes or so. What should we be doing? What should your people with a larger portfolio with pretty good diversification across locations, state locations and sort of areas, diversification in houses and units, diversification in terms of upside potential, like some development sites and some which are just like, what should we be doing right now?
Okay, so there are a couple of approaches here, right? One is that, at a very high level, you could double down and say, yeah, that's got done well. It's not costing me anything to hold at the moment. I can afford this much. Let's go out and buy some really strategic properties along the way to complement what we've already got. Yeah. The other thing would be that you need to now start re-looking very strongly at your mortgage structures and restructure everything to take advantage of the low rates to further enhance the cash flow within the portfolio. And then now's the time you start thinking of, okay, where does this end? Do I leave the loans alone, let it peter along and pay itself out? Or do I now put strategies in place to actually start paying this off? And there's only 3 ways you can pay things off, right? You either use your income to flush the loans and pay it down that way. You can use the cash flow from within the portfolio, or you can go out and create the money via property or any other vehicle for that matter. But because we're in property, we would say we can buy complementing properties with the intent to do something with them so that when it is feasible to sell, and we've sat down with the accountant to map out what the tax implications and everything are, we've got a finite plan then to say, okay, but over this period, we can pay down our portfolio by putting strategies in place.
And this is the 40-year plan re-engineered every year, because there are moments of a cycle where certain areas will run harder than the historical average, and they may have even been a piece of the portfolio that was what we call a transient asset. So an area that we don't think has a long-term or has longevity for the long term, or it might be high in maintenance and repairs, but we think there's going to be above normalised growth, and it'll be an asset that we purchase to sell in consultation with the accountants and what have you. But we can never measure that time period. So it's not, once again, it's not the lineal 7% per annum or what everybody talks about. It's having the finger on the pulse of the market, waiting, strategic patience, to be able to execute that part of the plan. Because at the end of the day, and this is maybe where we're a little different from others, is I'm adamant that eventually you want to retire the debt.
Yes, absolutely. Yeah,
it's not about keep debt at a constant level and just let everything amplify up in terms of its value, but also its rental income. I'm not that keen on that, because that's reliant upon rental growth consistently, mortgage rates being where they are, give or take a couple of percent, and no major changes in the economy. So for me, retirement of debt, unencumbered properties, is the most powerful thing that you can have, and it also gives you options.
No, that's right.
And options is what we're all looking for, because then options means you've got choice in how you want to do stuff. So that's at the back
Phil,
end.
Just something that's popped into my mind, which is, I talk to a lot of clients when you're doing reviews and getting into their consolidation phase, where we're starting to put strategies in place to retire the mortgage debt. One of the things that most people don't really know, and including some brokers as well, is the ability to use their facilities to help pay that down. So what I mean by that is that, let's say we've earmarked a couple of properties to sell down, and we don't qualify for finance, or our jobs may have changed. We've gone from PAYG to self-employed as an example and all that. A strategy one can use is doing a security swap with that. So let's say you're selling a property, and let's say the mortgage on that, the original purchase price on that was $400,000. Now it's worth, get lower, Steve says. Let's say the mortgage on that was at 200, like we get back into your portfolio. We can sell that property because now it's worth, say, 500,000-600,000. And so we're taking a very strategic approach to say, okay, this property is done what it is done, and this was one of our transient properties. If we offload that property, there's a choice where you don't discharge the mortgage and you replace that with security. Pros and cons, you have to be within that same price range as you originally bought. The pros of it is that you don't have to then go through all the paperwork of getting another loan and all that sort of stuff. So that's something that when you're selling property, there are a lot of different things that you need to consider. What's going to happen to the mortgage? What's going to happen to the profits? Where does it go? What's our tax position? And is it now the right time from our income point of view to offload it? And then where's the market? And understanding also that whenever you've sold property, you've sold all of its future gains with it. Right? So it's no sense looking back. I mean, we've sold a few properties in our lifetime, Steve, and every now and then, just to make ourselves feel
what's
feel
it
good.
worth today? Yeah.
No, I never do that. No, I can't look back because it just makes you cry. But
every time I want Steve to have a bad day, I just remind him of the properties we've sold.
Yeah. However,
what's the worst perform? Like, what's the worst one that you've sold for the best? That's got the best gains. There must be something you just go, why did I do that? There must be one.
Yeah, in my portfolio, I sold a duplex in Haberfield. That's in New South Wales.
Yeah,
that's in the city.
A great spot. Yeah.
But it served its purpose. It served its purpose, and off the back of that, I bought several other properties.
No, but that's the point. It served its purpose because it paid down existing debt on another asset to make it unencumbered. You've got the amplified cash flow. Where did that cash flow go? And that's the point of selling strategically. Now, I know there's going to be a lot of listeners out there or service providers, whether they be accountants or whatever, sophisticated investors saying never, ever, ever sell. And that's cool. That's fine. That's your strategy. That's your strategy. But for me, I don't want to be on P&I for 132 years, slowly eradicating debt.
Yeah. You want to be in an unencumbered position.
I want an unencumbered position because at the end of the day, it's not about the cash flow. Inadvertently, it is. It's not about the wealth position. It's about the choice.
Do you guys own many properties that are completely unencumbered?
Yes.
You do? Yeah.
Which is a good position to be.
You don't sit there going, just refinance that, get a bit and go and buy again, or you just don't need to.
It depends on what you classify as unencumbered, because there's unencumbered and then there's liquidity.
Yeah, okay.
because I'm a fan of liquid, be liquid all the time. And so it's
In other
Fully
words,
offsets, for example.
Yeah. Make your equity liquid. That's
Correct.
what you're saying. Yeah.
Yeah. Interesting. So that's sort of at the, I guess, sort of our end, sort of more sophisticated investors, we can call ourselves that. So we should benefit from what will be a bull run in property across our portfolios. So for those who are just going, I want to get into this, like, is now the right time to investing in property? If you go back to the sort of Buffett quotes, sort of be fearful when everyone's being greedy and be greedy when everyone's being fearful, right? Like, should have you been buying middle of last year rather than in this market, Victor? Or it's okay to start in this market, or it's good to start in this market?
It depends on your personal circumstances and what your long-term goals are, right? If you're jumping in just because everyone else is jumping in, perhaps not the right time.
And I'm not trying to talk down the market.
Yeah.
I want the market to go up
Sorry.
personally. Full disclosure.
buy in this suburb.
Full disclosure. I want the market to go north.
So for some people, now's not the right time to buy. If your job's not secure, if you're absolute red line when you buy a property in terms of cash flow, perhaps you need to re-engineer what you're trying to do. So this is where it comes in terms of strategic advice as to whether you should or shouldn't. And sometimes you want to be making sure that you're not just being held back by fear of overpaying on a property. There's no sense in overpaying a property, but then you need to look at where the market is. And if you take properties in any of our portfolios, we paid what the market values were at the time for that particular property.
Yes, good point.
It's what was the upside? Could I manufacture on
That's
top of
right.
organic growth? And
That's it.
whether it's a zoning play or a dual income play, whatever it may be.
Which is what we've done on some of our properties. I think of that Cambridge Park, for example. We bought that at
Correct.
market value at that point in time. I think the bank didn't really think it was worth that much because I think they had to sweep out the crack addicts. But
No, they didn't even want to be in there at that time.
but we manufactured equity as part of that as well, right? So
Instantly, within 6 months.
Yeah.
But I think in terms of the question, is now a good time to buy? And I think Vic answered it really well. It depends. Depends on your circumstances. If, however, you've decided, well, yes, it is a good time to buy, then my commentary around that would be tactically aggressive. Now, that means well thought out with a methodical approach. And the reason I say aggressive is that if you're lingering on the sidelines, if you're umming and ahhing, trying to determine value and everything like that around a particular area, property, street, tomorrow it's going to be worth more. That's the market that we're in.
And can I say that data's out the window now? It's all ground truth because data now has got that COVID filter on it, right? And that's something that we need to
That's
be
going
mindful
to be
of.
an anomaly forever. Historically, it'll be in that data point, and we'll be able to graph it in the years to come and say, oh, that was COVID,
And you got to think also is that where the market is also, to your point, it's consistent with this, Victor, is that the data you're looking at is got the COVID filter and therefore it's probably not reflective of what it is right now. That's also going to mean that you're probably not going to get your bank vals as expected at market val. Thoughts?
The market
gonna
is
take
willing
time.
to pay a lot more than perhaps when you're doing a refinance and the bank valuing it.
Yeah.
Most properties are coming up at purchase value.
So the banks
because
are
actually
acknowledging
valuing
purchase
it,
price, yeah.
Now, these are properties that we are sourcing.
Yeah.
If I come back to in terms of assertive action in buying property, one of the things that most people are doing wrong in this market is they're taking too long to do analysis, right? You need to have done your analysis, have done your loans, get finance ready well ahead of time, and understand that even most agents aren't keeping up with how fast the market is shifting.
And you can see that by the way that they're advertising,
Yes.
whether it's a price band or offers above or offers around. It's because the vendor and the agent don't really know what it's going to achieve because the
And
market
it's the
is
question
quite
around
wide.
everyone's going, oh, they're underquoting. They're under,
not.
they're
No, they're
underquoting.
not.
I think most would just go, just don't know.
We don't know.
Yeah.
And you've got to give them a little bit of sort of leeway here. It's like, try keeping up with the market, even as a buyer. And what I would like to think of as professional buyers, we're having to adjust our filter, and it's the filter for today, but we've still got to make sure that it's within our parameters for the future.
Yes. Yeah.
Because we don't want to be in a position where that as a buyer, that you're getting caught up in the hype and you're just trying to get on the coattails of a rising market to feel good about life, as opposed to, well, what's going to happen in 5 years' time? Which is, in our mindset, 5 years is short term.
Very short term.
It's tomorrow.
Yeah.
So that's good. So those two, I guess it's a bit base, but those two sort of profiles that we spoke about, i.e. people who are already property investors who have a significant portfolio thinking about what next, and then those people who are new to the market. A lot to unravel there. What's the best way? You guys happy to chat with people around that, Victor? What's the best way to do it?
Yes, certainly. Just to flag, there is a bit of a time lag to sit down with either myself or Steve, sit down on Zoom. The process would be to go to our website, request a initial discussion.
Okay.
And in the background, what I would suggest you do is you start getting your finance ready, right? So get your loans approved as high as you can. That doesn't mean that you're going to buy at that level. But by the time you've got that and you're sitting down in front of us, we can then adjust that approval down in line with the strategy that we can map out for you, so that you're not then going back and trying to get the loans and everything ready. And if you don't have a good broker as such, when you're contacting us, just flag it. We'll put you in touch with some really good switched on people.
Okay, that's good. Now, Steve, let's bookend this episode 1 of season 5 of the Investing Inside the Right Property Group. Your key objective for this year for this podcast, and we're going to play this back come December and see how you've gone against this. What is
Key objective?
Yeah.
For me, it's
we get one each.
Ah, okay.
You get one, he gets one, I
That's
get one.
pressure. Keeping it real, keeping it consistent. And what I mean by that is let's not let the market cloud judgment and run away between our ears. Let's look at everything in a very strategic, methodical way and act accordingly.
Victor?
Yeah, to echo a little bit of what Steve said, this year I want to spin away from the hype and spin towards fundamentals and keeping it consistent and real so that people don't get caught up in this mad rush to get onto the game. So it's more of a sedate, do this first, you get the fundamentals right, tick all the boxes before you jump in feet first.
That's good. And I guess that's framed around if you want to go and find information that tells you all the hype in the market and why you need to get involved, that's not here. That's not here. This is right. Where you're going to actually get what's really happening.
Yep.
What's really happening and make more decisions. I guess the outcome I'd want, and probably consistent with your point around the bit of a time lag getting together to have a chat with you guys, is that the objective I want is to get people, if they go down a pathway of using a buyer's agent, whether it's you guys or whoever, they're actually, it's a lot more valuable for them when they do that. Yeah, just having a chat with a property strategist or a buyer's agent going, oh, what do I do? It's not going to be a very constructive conversation. I think by the time they want to go and sit with guys like you, they need to know. Like, there's no excuse not to be educated around property now.
It's all good to be
quite
reactive
advanced
to a market and to your own personal position, but there's a workup beforehand.
You've got to work it up. Know your numbers. Have your own budgets. Have your own spreadsheets. Like, imagine if you sit down with someone, you go, well, how much sort of free cash flow do you have every month? Or what's free cash flow? Like, turn it off. Go away and get educated, mate. So that would be an objective.
Listen to the podcast.
Listen to the podcast. so that would be an objective of mine, is that it's a help with education. So you can actually, another point you made is that you can't sit around and analyse forever in this market. If you're going to get in the market, get
yourself ready.
Get your stuff sorted out so you can actually be decisive. So to help with speedy, decisive decision making. So I think they're really good objectives. Will score us come December, Steve. There'll be a gold-plated Big Mac for the person that wins.
A gold-plated Big Mac.
The Golden Arches, huh?
Golden Arches.
Golden Arches. Do you know what? They go back to our...
Woodstock Avenue is where we go, isn't it? So Woodstock Avenue?
No, Penrith. That's where you and I sit down here. I'd encourage everybody else to go back to our end-of-year podcast forever and ever and judge us on how correct we've been.
Yeah. It's, questions at rightpropertygroup.com.au. 5 gold stars for Phil Tarrant. 4.5 for Victor Kumar. I don't know what you think you're worth.
It's not what I think I'm worth, Phil.
That's what the listeners do. Anyway, we digress. But thanks for joining us, everyone. I hope you've enjoyed that chat as we embark on season 5 of Investing Insights Right Property Group. We'd like to have a lot of fun here. Get in touch, let us know what's going on. Questions themselves, you want actually to answer some questions on air, happy to do that. That's cool. Any comments, remarks, any way we can improve it, anything you dislike about what we're doing, we're always open for constructive criticism to help improve what we're creating for you property investors right across the nation. Victor, Steve, thanks for your time today. Really enjoy it. And we'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature, does not take into consideration your financial situation or individual needs, and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise